Hey, Steve Saretsky here. Welcome back to the show. A big week or so here. I've been following along, of course, the Justin Trudeau Prime Minister resignation in this country. I highly encourage you to go check out the Loonie Hour podcast that we just put out with a special commentary guest on the politics of it all and what this really means. But in short summary for you here, is we have one of the most economically illiterate prime ministers in his country's history has announced that he's resigned or is resigning. He's prorogued parliament, which basically means he's shut down parliament until basically the end of March. What likely to happen is that there will then be a confidence vote once parliament resumes. They're gonna hide Trudeau's going to find a new leader. It's probably going to be Chrystia Freeland or Mark Carney. They're going to step in. They're going to become the leader of the Liberal Party for a couple of weeks. Then what's going to happen is there's going to be a non-confidence vote at the end of March, which will then trigger an election, which means you'll probably end up with a Pierre Poilievre conservative government, likely by end of May, early June. That's the most likely scenario. Of course, things can change. We will see. But between now and then, we have a lot of uncertainty, a lot of chop. Of course, we've got Trump being inaugurated next week. Clearly does not like Trudeau, but Trudeau is going to be negotiating with him on the tariffs. So you have this lame duck prime minister negotiating the tariff situation with Trump. Every Canadian economist that has analyzed the situation says, listen, if Trump says what he says he's going to do, the Canadian economy will be in a recession within 6 months. So clearly not good for things such as housing. Obviously, if you're going to go and buy a house, take on a big mortgage, you want to have economic certainty, not only about the economy, but about your job. So speaking of the job market, we'll get to that in just a second. The one sort of positive note for real estate people out there, real estate investors out there, is that by Trudeau proroguing Parliament, it actually puts the CRA capital gains inclusion rate. So remember, they increased the capital gains rates last summer. That bill never passed. It never passed, but CRA has been administering it as if it has passed. But now by proroguing Parliament, that bill is dead. It's dead in the water. But CRA, of course, CRA is doing CRA things, is going to continue to charge that until basically the government falls and that gets reworked. So people that are disposing of real estate assets this year in 2025, of course, talk to an accountant, but most likely will not be subject to the higher capital gains inclusion rate. So a total sort of final boondoggle on his way out has been this whole capital gains thing, of course, choking off investment, and now penalizing people that disposed of assets under a false pretense that the thing was actually going to pass. So again, a lot of uncertainty around the labor market, what's going to happen. So we have to keep our eyes on the labor market. We know what's been happening here in Canada, which has been unemployment's been ticking higher and higher. You got youth unemployment, the highest since basically the GFC. It has been trending in the right direction. All of a sudden, out of the blue, we get the Canadian employment statistics for the month of December. We added 91,000 jobs, way beating all expectations. Added a whopping 91,000 jobs, 44% of them were from the public sector. So a lot of government jobs, not a lot in the private sector. But this is where I say, you can't put too much stock into 1 month's data of a highly volatile data set. 91,000 jobs in Canada is pretty much the equivalent of about 1 million jobs in the United States, right? I mean, the U.S. population is 10 times the size of Canada. So 91,000 jobs is almost 1 million jobs in the United States. And just for context, the U.S. released their jobs numbers this week as well, also beating expectations, but they added 256,000 jobs. The estimate was 165. So the U.S. beat as well, but they beat with 265. So you're telling me Canada added, 90,000 jobs, and a population is a tenth of the size of the U.S. Something doesn't add up there. And again, I think that, we've had our beef with StatsCan over the years in terms of we call the random number generator, which is their employment numbers bouncing all over the place. But nonetheless, what does this mean? Well, I think we can kind of fade the noise of the Canadian jobs data. You can kind of fade that noise. 44% of jobs covered from the government sector. The real kicker here is the U.S. jobs data. And we've talked about this again. This has been the theme of the show, and it's all playing out in front of our very eyes here. I've been telling everybody here, again, I don't get everything right, but there's certain things where you talk about and then they start funneling through. Is the U.S. is the economy is stronger there, and it's a hell of a lot stronger than the Canadian economy, and that is coming in stronger than expected, not only from an economic perspective, inflationary numbers coming in stronger than expected. That is forcing the Federal Reserve, that they are probably done cutting rates. As of right now, for the next meeting on January 29th, the markets are pricing in a 3% chance that they cut 25 basis points. So basically, the market is saying no Fed cut in January, and realistically, you continue to get numbers like this, they are done. And so what does this do for the Bank of Canada, right? If your neighbor to the south has this really strong economy, your economy really stinks, you need to cut rates, you need to help out the over-levered Canadian consumer. But to the south, that economy is so strong that it's pushing yields higher here. So what do we see? We saw to start this year, the Canada 5-year bond yield is up 20 basis points. Just on the news today, on the job data coming out of Canada and the U.S., the Canada 5-year bond yield is up 10 basis points. It is not often that you get a 10 basis point move in a single day on the 5-year bond. So what we're seeing now is mortgage rates pushing higher. And again, I caution people this. The narrative that I heard towards the last half of the year is the Bank of Canada is cutting rates. Everybody knows they're cutting rates. They're going to continue to cut rates. And so the market's going to get better. Mortgage rates are going to come down. We've seen a lot of people going back to variable rate mortgages because, hey, cuts are coming. I can always lock in. Well, lock in when? I mean, are the fixed rates really going to move a whole lot? And everything that we're seeing is that, listen, yeah, the Canadian economy sucks, but the U.S. is outperforming, and that's raising our bond yields here in Canada. And so fixed rate mortgages have actually been moving higher to start the calendar year here in Canada. So if you are a prospective home buyer, if you are a person that already has a mortgage that is coming up for renewal or in the next couple months, my suggestion is that you reach out to your lender, your bank, and ask for a mortgage rate hold. You should be locking in a rate. You can typically hold a rate for 120 days. You should be holding and securing that rate at least as a minimum to hedge your bets. Hey, listen, a lot can happen over the next several months, right? The next 2, 3, 4 months, rates could very well come down. They could maybe end up in the high threes. It's very, very possible, right? We just talked at the beginning of the show that, hey, listen, Trump tariffs are probably coming, and you could see a Canadian recession within this first 6 months, assuming these tariffs are implemented, which, naturally one would assume that bond yields would come down to reflect that recession. So again, a lot can change, but why not hedge your risks? If you know that you need a mortgage in the next 1 to 3, 4 months, you may as well at least hedge your risk today. So worst case scenario is if bond yields continue to push higher because economic data comes in stronger than expected, inflationary concerns reemerge, that you've at least hedged your risk. Now, again, predicting this, I get so many questions. Where are mortgage rates going? Where are they going to be a year from now? Are house prices going to go up over the next 24 months? Guys, I'm not here to forecast things. I'm here to give you, my thoughts and insights, at least from a probability perspective. I think assigning things in probability terms is relatively a much safer bet than giving absolute views. I mean, of course, you look at the comment YouTube section and everybody knows exactly where house prices will be 6 months from now, 12 months from now, 24 months from now. Everybody knows exactly where rates are going. There's a lot of very, very smart people here in the YouTube comments, but I would just point you to, on the prediction side, I would point you to the big 5 banks, let's call it the 6 large Canadian banks in this country. They just put out their forecast for the Bank of Canada's overnight rate and where they see the 5-year bond yield at the end of the year. So again, the overnight rate is the Bank of Canada adjusting rates up and down, okay? That is what prices your variable rate mortgage. So the overnight rate will flow with the prime rate. The prime rate is what prices your variable rate mortgage. So typically what you'll see the bank will say your variable is prime minus 1%, let's say. So whatever prime rate follows the Bank of Canada's overnight rate. And then you have the 5-year bond yield, which prices your, let's call it your 5-year fixed rate mortgage. It's a very, very good proxy. So the 6 Canadian banks put out their sort of forecast for the year. Keep in mind how many salaried economists they have on their payroll, how many quants and data sets they're looking at. You know, these are relatively smart people. And you look at the 6 forecasts and like, there's some pretty stark differences between the 6. So you have to say, well, like, who's looking at what data? And this is the thing, is like these things are so hard to predict that you've got 6 banks and none of them really agree on where things will be 12 months from now. So, you know, if you look at it, the general consensus is that the Bank of Canada's policy rate, which is currently at 3.25%, will more or less be around, called 2.5 by year end. So they're basically forecasting 75 basis points of cuts. But you've got outliers like Scotiabank, which is suggesting that the policy rate will be 3%. So they're saying one more cut from the BOC and done. And then you get more aggressive banks like RBC saying 2%. So they're calling for 125 basis points more of cuts. I mean, that's 100 basis points difference between the two banks. If you look at the 5-year bond yield, you've got Scotiabank, again, at 3.5%, which is about 40 basis points higher than where we are today, versus, you know, RBC or National Bank, which is coming in around 2.5%. So a good, let's call it 60 basis points lower than where we are today. So there's some wide divergences in the possible outcomes that we have today. But even if you look at RBC's forecast or National Bank's forecast for the 5-year bond yield to drop to about 2.5%. So again, that's about a 60 basis point change from where we are today. That would probably bring your fixed rate mortgages to about, call it, in the high 3s, you know, maybe 3.5 on the low side. So again, the idea is that even if the Bank of Canada cuts aggressively by another 100 basis points, fixed rate mortgages probably aren't going to be moving a whole lot. Like, we're going to be probably range bound here between upwards of 5 to in the mid 3s, 3.5 to 5. That's kind of your range. So we're not going back to the days of 1.5%, 1.8, 2.2. So people are going to have to adjust, and you have to factor this in. This is all based on probabilities. Lots can happen, but as I just outlined here, the probabilities and the forecast from the 6 large banks are all over the place. So it really should tell you, you know, when you hear from people that speak in absolute certainties about the direction of rates and the direction of real estate prices, I would just caution you, as someone that sits here and participates and is on the front lines of the real estate market on a daily basis. Even for someone like myself, I don't speak in absolute certainties of where housing and house prices will be 6 months from now, 12 months from now, 18 months from now. I think that directions are relatively easy to call. I think that you can call rebounds and activities and have ranges on probabilities, but to speak in absolute certainties is where I would really caution people. Again, I bring this up because I get a lot of calls, emails, people wanting to jump on, you know, consultations about, hey, you know, when should I buy? I was like, well, you should buy when you can afford it and when it makes financial sense for you. You know, I can't tell you if you should buy in 6 months, 3 days, and 2 hours from now. So anyways, that's what's happening. Again, big last week or so, our prime minister has resigned. Trump's being inaugurated. Tariffs are coming. To what extent, we don't know. The labor market, the data is random all over the place. We think we know the trend is up. The Fed is probably done cutting rates. If not, maybe they squeeze in one more. The Bank of Canada is probably going to have to continue to cut rates due to the overleveraged Canadian consumer. Every 25 basis points of rate cuts unleashes about $7 billion of cash flow into the Canadian economy. That's the math from RBC. And so the Bank of Canada is going to keep cutting rates. Assuming they do, that would reflect in the currency. I've said before, I think the currency is the release valve. That's why the Canadian dollar is trading at, 69 cents today. I think there's a high probability it moves lower. And so, do your best, position accordingly. And we'll continue to update you every week. This is the fun days of financial markets and politics, and we'll continue to watch along. So see you next week.